Okay, good evening, everyone. You are welcome to today's
Good
class.
evening.
In our class
Thank
today,
you, sir.
we shall be taking the topic, History of Value Added Tax and General Principles. We will be taking History of Value Added Tax and General Principles. So before we proceed, last week, we started with the introduction to the course by looking at the general overview of indirect tax. Okay, so looking at what indirect tax is, we discussed the definition, the various types of indirect taxes. We discussed the benefits of indirect tax and some other, subtopic in that particular topic. So Mrs. Abosede was in class. Gold, I believe you're also in my class last week. So you guys should please tell us some of the key takeaways you learned from the class last week. So what are the key takeaways you learned from the class last week? Okay, so in 5 minutes, can we do that?
Okay, for me, indirect tax, one of those taxes that everyone gets to pay, whether you're in a structure, that for me, I took away with. And then the examples of indirect tax, we have the VAT, we have the import duties, custom duties.
Okay, so Mrs. Abosede, do you want to try?
Yes. I learned that indirect tax is a tax that is being imposed by the government and is being paid by manufacturer in a supply chain. Meanwhile, that means the manufacturer to wholesalers to retailer to final consumer, and the burden is being shifted to the final consumer. And the example of indirect tax are value added tax, duty, excise duty, import duty.
Okay.
Then we also learned about the
Okay, so Ambrosia, you're also in class. Do you want to try?
Okay. I was in class.
So
we talked about
what are your key takeaways from the last class?
Of indirect tax. We talked about the personal income tax, the company income tax, stamp duty, capital gains tax, excise duties, and one of the features of indirect tax is that it's the final consumer that pays indirect tax when it relates to value added tax. And they are not paid directly. They are included in the total price, in the total purchase price, or is added to service. Then we talked about the advantages of indirect tax. We said it is easy to collect and it is not easily evaded. It is also equitable, that is, the rich and the poor pays the taxes. Okay.
Okay, so
We talked
thank you.
about the taxes
Okay,
collected by
go on.
state governments. Yeah. Okay.
Go on, go on, go on, go on, go on.
Okay. We talked about the taxes collected by state government, the local government, and the federal government. And we said the personal income tax, such as pay as you earn, is collected by the state government. Then we said tenement rates, shops and kiosks is collected by the local government. Then for the federal government, we talked about some parastatals such as FRS, foreign affairs. I think those ones, their taxes go straight to the federal government, something like that.
Okay, thank you very much.
Yeah.
I really appreciate that. So it means you guys do pay attention to details during the class, so which is fine. So I hope you maintain the pace or probably do more than this. Okay, so I encourage you to do more better. Okay, so in brief, just to add to what you guys have mentioned, so we look at the definition of indirect tax. So it was discussed or defined to be a tax that is paid to the government by one entity in the supply chain. Basically, it starts from the manufacturer, but in some cases, so it may start from the extraction industry. So I made use of an example of a farmer. Okay, so who is into cultivation of raw foods. Okay, so from the farmer to the restaurant person. Okay, so now let's say from the farmer to the market people. Okay, so these guys, do not charge VAT because we are talking about basic food item. Okay, so those are excluded from the VAT scope. Then also, but when it gets to the restaurant person, okay, so because it will have to go through, it will have to undergo some processes. So a good example I made use was ShopRite. So or you probably go to Chicken Republic, to order for your food. So if you take note of your invoice, okay, so you get to know that invoice, your invoice the invoice amount is inclusive of both consumption tax and value added tax. It's inclusive of both consumption tax and value added tax. So in that case, by one way or the other, you are paying what? You are paying tax. Okay, so we also mentioned that a lot of people are not aware of this tax simply because they don't feel the impact. Okay, simply because they don't feel the impact. And the manufacturer also pass the burden to the wholesaler, from the wholesaler to the retailer, then from the retailer to the final consumer. Remember, we make use of Gucci. That was our illustration in the class. So Gucci was used as an example. From Gucci to ABC store, from ABC store to what was the name? Spa, then from Spa to Abosede. Okay, so and with that illustration, so we also attach an amount to each of the stages of the transaction just to tell you how it works. Then also we discuss in brief the inputs and outputs VAT. So also we discuss the custom duty, not just VAT that we discuss, we also discuss the custom duty, excise tax, and stamp duties, if you can still remember. And then we look at the constitutionality, of the indirect tax. Then also we make reference to other tax laws, such as personal income tax and the company's income tax. So in today's class, we are growing. So after knowing what indirect tax itself is, so it is necessary for us to now go into detail of each type of the indirect tax. So we are starting with the value added tax. So yeah, we are looking at the history of value added tax and the general principles. So by the end of this class, I want to believe that you will understand the definition of value added tax, then also the difference between the variants of tax practices in Nigeria and the variants in most parts of the world, then also the principles for cross-border, transaction. So that's the international trade. Okay, so you look at this destination and source principle of taxation. So I hope you find this class interesting. Okay, so what is VAT? So let me ask you the question before I explain further. What do you understand by the term value added tax? So jokingly, I mentioned it while taking the income tax this morning, that for when I was when I was explaining the decided cases between uh, spring, warm spring, and then other companies, 7-Up bottling company is there, and some other big companies. So the issue they're having is they requested for their tax clearance, and then the tax authority, which is the FIRS in this case, refused to grant them, their tax clearance. Then what was the issue? The issue is the FIRS is requesting for what? For the payment of value added tax, for the payment of value added tax on what? On bottled, on bottled water, on bottled water. Good, can you still remember that? Ambrosia, you're also in that class.
Yes, I can
Yes,
remember.
Also in the class. So then what was the conclusion or the decision of the judge that presided over the case? So the judge said no, that the FIRS cannot, withhold the tax clearance of this company simply because it is requesting for the payment of value added tax on bottle. And the judge even was banned the FIRS from charging value added tax on bottled water. So jokingly, I said, why is FIRS requesting them to pay what? To pay value added tax? Because they have added value. Okay, I said because they have added value. So because if you ask someone to tell you what VAT is, he or she may say value added tax is the tax that you pay when you add value. Are we together? Okay, so I believe you guys will hold my hand, despite the fact that I'm showing some of the definition on my screen. So I just want you to close your eyes and tell me what you understand by the term or by the words value added tax. So who is taking the mic?
Okay. Value added tax is a multi-stage consumption tax.
Hope your two eyes are closed.
Yes. It's a multi-stage consumption tax paid on goods that are purchased and on services that are rendered.
Okay. So let me assist you. So when you are saying goods or services, so you need to make it clear. So there are vatable goods and there are non-vatable goods, as well as zero-rated goods and services. So we have vatable goods and services, and we have non-vatable goods and services. Okay, so
Okay.
meaning that you may explain further. It is good to say value-added tax is a tax levied on the consumption of goods and services. Then you can say, in other words, these are taxes levied on what? On goods and services that are vatable. Okay, so you can
Okay.
say that in line with the Value Added Tax Act, okay, there are some goods and services that are VAT, that are non-vatable, and we also have zero-rated goods and services. Then you give example. This is how you know,
Okay.
take the examiner. Just imagine that's the first question the examiner is marking. The allocated mark may not be too much, maybe 2 or 3, but you've got the examiner, the marker impressed. Okay, so and remember, first impression do what?
Matters a bit.
So it goes a long way. So that's just it. Okay, so meaning when you are writing your exam, the examiner will be happy to also see some examples. The examiner may not ask you to state the examples, but after giving the definition, just tell the examiner that I know better than you can give examples. Okay, so I wish you guys the best. So VAT is a tax levied on goods and services rather than what? Rather than income or profit. Rather than income or profit. So you can see goods and services, not on income or profit. So can someone give me an example of tax that is levied on income or profit? Hello?
Income tax.
Oh, you may have to change your location. Okay.
Mhm.
Is
Yes.
it okay?
Just you can just change your direction or move away from the algorithm.
Is it noise or poor network?
Poor network, poor network. Okay, so
Network and the weather is really bad here.
yeah, sorry. Don't worry, we manage the situation. So you can always drop your response in the chat box.
Yes.
Thank you. So Ambrosia, you want to speak?
Okay. The tax is levied on income. We have personal income tax.
That's good.
Then
One is okay. One is
taxes.
okay. One is okay. I know you said it. So I could see Mrs. Abosede trying to unmute her mic as well. Okay, so Mrs. Abosede, do you want to add to that? So any type of tax that is levied on income or profits. Okay. Sorry, Ambrosia, I should have allowed you, but I don't want to feel guilty. So other income, other tax that could be levied on income or profits is what are companies income tax. Just permit me to use the abbreviation. Company income tax, personal income tax, petroleum profit tax, and what? Capital gains tax. And capital gains tax. Are we together? Okay, so thank you, good. Company income tax, I got the message. So generally, suppliers of goods and services in Nigeria are required to collect VAT at what rate? At 7.5%. They are not just collecting it because this is not their money. They must send it to the owner, okay? So without delay, because for every delay, there is an implication. And what's the implication? Failure to remit the tax as at when due. Good, what's the implication? Ambrosia, what's the implication for remitting your VAT returns as at when due?
If you remit it as at when due, nobody will charge you for the fault.
But when you don't remit as at when due, what's the implication?
There's a fee of I
And
think
what's that?
50,000 naira for VAT.
50,000 naira for the
For
first month you fail.
yes, for the first month
So
I pay on VAT, yeah. While on
okay.
company income
Then
tax is
subsequent months,
25,000.
Leave company income tax. We are in indirect class tax.
Okay.
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 So
Subsequently, it's 5,000 naira per day.
no, you fall my hand. So you
All
pay
right.
50,000 naira for the first month the failure
Oh,
occur, and
yeah.
subsequently you pay 25,000 naira, not 5,000
Okay.
naira.
25. Okay.
Okay. So that's for you are referring to income tax. Okay.
Okay.
You are referring to
Yeah.
income tax. Anyway, don't worry. Yeah, you will get used to it. So they must remit this to the FIRS on or before the 21st day of the following month. Then most service providers usually charge their clients VAT in addition to their services. So if you are working as a professional, or let's say a lawyer or consultant, you will always charge VAT. So if you are working in a company as an accountant, you must have seen an invoice from your vendor or from your lawyer or your auditors. What again? Okay, consultants, tax practitioner, and the likes. You after seeing their professional fee, you also see what's at the bottom. You see value added tax at 7.5%. Are we together? So this is an indirect tax. We all know by now. Then it is collected by one entity in the supply chain, such as the manufacturer or retailer, and paid to the government. However, the tax is passed to the final consumer as part of the price of the goods or services. Are we together? So do you know we have not started today's class? We are just or we're about starting the class, and you've known almost everything we're about to discuss. Should we call it a day? Or can we call it a day?
No, sir, there is no.
Okay. No, no.
No,
Okay.
sir. No, sir.
I'm going by your votes. So then the definition again. So I'll not be taking much time. So it is unarguably that value tax is one of the finest physical instruments for taxation. Okay, so it's one of the finest physical instruments. Almost everybody pays, whether you are educated or you are illiterate, you pay. You can't escape it. You can't escape it. Okay, so whether you live in the rural area or you live in the urban area or you live in the village, do you know village people to pay VAT? Do you agree with me that village people pay?
Yeah.
They pay VAT
Agreed.
because in some villages, modern villages, most of the villages are now modern. So they use telephone, Abby, and they recharge their line, isn't it? Apart from
Yes.
that, they have
They consume.
TVs, they have radios, Abby. What else? They consume electricity, isn't it?
Yeah. Yes.
Among others. So one way or the other, they pay VAT. Everybody in Nigeria, in this country, except those that have chosen fasting over and above eating. So they fast every day. They have not been eating for some years. Do you know anyone like that? It's not possible.
But
So
they
you
will
must.
always recharge their phones.
Okay, if they are not eating, they recharge their phones, Abi.
Yes.
Thank you. So VAT is universally acclaimed as the most effective remedy for all sorts of tasks, created problems in developing as well as developed economies. Okay, so because you don't feel the impact, because your mindset, according to the economists, you know, when, for instance, now you are tasty and you need to, quench that taste. So your mindset will be on what? Will be on that solution to quench the taste. So let's say you want to take Coca-Cola, for instance. Okay, you want to take Coca-Cola. So you don't mind the amount it will cost you to take that Coca-Cola because of what? Because of that's your needs at the moment. Abi, that's what you need at the moment. So, and because you have the purchasing power, you will definitely want to get it. Are we together? So again, the idea of this value-added tax, okay, because I've only, talk about the definition, okay. So the idea of this value-added tax came around about in the 19th century, let's say in the 1920s, okay, by a German businessman whose name is von Siemens. Okay, so his early proposal to introduce VAT, came up in France. So the France government introduced the VAT. Then this guy is the first person to conceive that VAT. Okay, so he conceived the VAT in France in 1920s. So the first VAT appeared in France in 1948 and applied to all manufacturing states. Okay, it applied to manufacturing states only, and there was no credit for capital goods. There was no credit for capital goods. So then later it was converted to what? It was converted to consumption tax. That should be 1948. Okay, that should be 1948. No. That's not 1948. When they apply it to all manufacturing companies, 1948. Sorry, this should be 1954. Okay, so meaning after 1920, when this guy first conceived it from the France government, then in 1948 it was introduced to the manufacturing states. Then later it was changed to what's consumption tax in 1954. So by 1960, Senegal and Cote d'Ivoire. Okay, Senegal and Cote d'Ivoire. So Cote d'Ivoire adopted in 1960, exactly 1960. That's Ivory Coast. Then in the 1960s, Senegal also adopt same. Then later some other countries, Brazil, Denmark, and our beautiful country, Nigeria, also adopt it. So if I'm not mistaken, I think we started it around 1990 something, or let me say the 90s. Okay, so it should be 1992 or 1993, thereabouts. Okay, so that's meaning that the value-added tax, was widely known was globally known between the 1970s and the 1990s altogether. So that's just a brief. For more detail, so you can do your Google search or pick up some other study tests, your CITN study test, ICAN study test, or some textbook. You can look at Tejutas, Abdrazak Kabolurin, and the likes. Okay, so we have variants of value-added tax. So we have variants of value-added tax. There are just three. Okay, so it means that what you refer to as value-added tax, or the basis of value-added tax in your country, may be quite different in another country. Okay, so we have the gross product variance. How does this work? So the gross product variance allows for what? Allows for deduction. Allows for deduction for taxes. Deduction for what? Deduction for taxes on all purchases. On all what? Deduction of taxes on all purchases, on all purchases of raw materials and components, purchases of raw materials, permit me to use abbreviation, and what? And components, raw material and components, but it does not allow for deduction of capital inputs, but no deduction is allowed. No deduction is allowed for what? For taxes, on capital inputs. And that was how it started in France. Okay, that was 1948 when it was introduced, to the manufacturing states. So in that case, they can, they are allowed to deduct for taxes on all purchases of raw materials and components, but they cannot deduct value-added tax, on capital input. So what is capital input? That should be your question. So capital inputs in this case is any expenditure that is capital in nature. For instance, VAT that was paid on the acquisition of motor vehicle. You acquire motor vehicle. Okay. So, or VAT that was paid on the acquisition of any movable assets. Do you understand? Okay. So, hello, I hope you got my explanation clear.
Yes, sir.
Yes.
Okay, that's good. Then we have the income variance. So the income variance allows for deduction on purchases of raw materials and components, as well as depreciation on capital goods. So you can see it's a bit different from one. So it allows for what? It allows for deduction. It allows for deduction of taxes. Okay. On purchases of raw materials and components as well as depreciation on capital goods, as well as depreciation on capital goods, as well as depreciation on capital goods. So these methods provide incentives, to classify purchases as current expenditure to claim set-off. Okay, so it allows for classifying expenditure or purchases as current expenditure to claim set-off. Then what is consumption variance? What is consumption variance? Any idea? Since we know what gross product variance and the income variance is. So any idea on consumption variance? I want to try. Nobody?
It allows for deduction on business purchases, including
Business
capital
purchases?
assets. Yeah.
What kind of purchases? What are you purchasing?
Maybe capital assets.
Any capital asset? What of raw materials and components? Anyway, you tried. So consumption variance under the consumption type of VAT. VAT is based on consumption, and that's where we are going. So in this place, deductions are what? Deductions are allowed. Deductions are what? are allowed for purchases, deduction are allowed for purchases of raw materials and components, raw material and components, and what? And capital goods, and what? And capital goods. So this means that the base of tax is consumption. And since investment is relieved from taxation under what? Under this type. So the implication of this is that in your income statement, any VAT on what? On purchase of raw material is claimable as what? As an input VAT against VAT on sales, which is referred to as output VAT. Then any VAT you pay on expenses such as professional fees, legal fees, auditors fees, tax practitioner fees, or tax consultant fees, and the likes are what? Shall be expensed through the profit or loss, meaning you cannot claim them as what? As input VAT. What do I say? You cannot claim them as what? You cannot claim them as input VAT. You can only claim them as what? You can only claim them. So they will be what? They will be an added cost to the cost of that services you enjoy. Do you understand? There will be an additional cost to what? To the cost of the services you have enjoyed. Am I speaking sense?
Yes,
Hello.
sir.
Then for VAT on motor vehicle, it is also allowable. Okay. And the only way you can claim it is to what? Is to add it to the cost of what? The cost of the motor vehicle. To add it to what? To add it to the cost of the motor vehicle. But if it will be allowed as an input VAT, because it depends on what you trade in, okay? If it will be allowed as an input VAT, then it means you cannot claim it, you cannot add it to the cost of the motor vehicle, okay? But if it is not allowed to be input VAT, then you add it to the cost of the motor vehicle, which you capitalize, and when you are computing your capital allowance, it will be available for relief. Are we together? Okay, so these are the what? These are the variants of value-added tax. Then we move to the methods of computation of value-added tax. We also have three methods here. The first one is addition method, second one is subtraction method, and third one is tax credit or invoice method. Are we together? Hello, are we together?
Yes, sir.
So can you close your eyes and tell me the three variants of value-added tax? What are the three variants of value-added tax? Mrs. Abosede, what are the three variants of value-added tax? Lai Wowe. Oh yeah. Mrs. Abosede, are you there? What are the three variants of value-added tax? Okay.
Invoice method.
Income variance, okay. What else?
Additional income method, that tax credit or income method.
No.
No, additional method, subtraction method, and invoice
No. What are the variants of value-added tax?
Okay, variance, consumption variance, cross product variance, and income.
Okay. So, good. Is that correct?
Yes, she's correct.
Thank you. So, we also have three methods of computation of that. There are addition method, subtraction method, and tax credit. You should not forget this. Remember your addition and subtraction. So just put addition, subtraction, tax credit. So Now, how do we go about each of these methods? So for the addition method, this method aggregates all the factor payments, including profits, to arrive at the total value added, on which the rate is applied to calculate the tax. So it means if you have, let's say, not to determine your selling price, for instance, okay? So you know your selling price is inclusive of your profits, okay? So in that case, you add all your purchases, okay? You add purchases plus profits, okay? So whatever it gives you, you know, it gives your selling price, then you charge VAT on it at what? At 7.5%. Charge VAT at 7.5%. Again, this method aggregates all the VAT supplements, including profit, to arrive at the total value added, on which the rate is applied to calculate tax. So this type of calculation is used mainly with income variance. It's used mainly with what? It's used mainly with income VAT. So this method is not suitable for exempting exports and valuation of imports under the destination principle. This method is not suitable for excluding what? Exports and valuation of imports under destination principle. So another disadvantage of this method is that it does not facilitate matching of invoice for detecting application. It does not facilitate matching of invoice for detecting application, because what you are looking at is just purchase, then do a markup of the profits, okay? Then you charge the value added tax rate. Then you charge the value added tax rate. So that's for that. Then the subtraction method, okay? For the subtraction method, this method, is like having a total purchase subtracted from sales in arriving at the value added by the firm. A total purchase is subtracted sorry, I don't know why my pen is doing. It's subtracted from the sales in arriving at the value added by the firm. So what's the value the firm have added? How do you know the value? So we look at it from this angle. Okay, so what's your sales? Your sales is, maybe your sales is 20,000 naira. Okay, your sales is 20,000 naira. Then you minus the total purchase to make that sale. Okay, so what's the total purchase to make the sale? The total purchase to make the sale is, let's say, 12,000 naira. 12,000 naira. So what will be the what? What will be the value added? Hello, what will be the value added? Eh? What will be the value added? Oh yeah, talk. Ambrosia, talk now. Go.
8,000 naira is the
8,000.
margin. So I don't know if I should call it
You don't know,
value added.
but you guess right. It's 8,000 naira. So you just let's use our Oxford dictionary this time out. And jokingly, I said it in the income tax class, and I've also repeated it at the beginning of this class. Value added. Because the pure water people, okay, those companies, they have added value to the water by bringing bottle. Some years back, there's nothing like bottled water. And if there is bottled water, maybe in government offices for the high, individual, high personality individual, okay, or people with high net worth, individual like that. So it's not something common. So, and even when you are doing party, what you see is what's it called? Even in fact, when I was growing, is this ice water that I know. Ice water. So it's later we start seeing pure water and the likes. Okay, so they have added value to it, and that's just the fact, that's the bitter truth of it. So they have added value. So, and because they have added value, they will not sell it at a cheap price, like. Okay, they will not sell it at the same price you are buying your ice water. How much are they selling ice water then? When they brought pure water, compare the amounts, the amounts they are selling pure water with the amounts we used to buy ice water then. When they introduce bottled water, compare the amount you get bottled water with pure water. So if you go to a restaurant now, on average, probably you can see bottled water for 200 naira. But in most restaurants, start from 300 naira. Some people charge 400 naira for bottled water. So that's just it. So they have added value. So this is the selling price or the sales, and this is the purchases. So the variance, the margin is what is the value added. So for subtraction method, it is on this 8,000 that you apply your value added tax. Is that what we practice in Nigeria? Hello?
Yes.
Are you sure? Is that what we practice?
That's what it's supposed
I-
to be.
You are not even sure. See? Anyway, it is similar to what we practice. Okay, it is similar to what we practice because it looks like tax credit method. Okay, it looks like a tax credit method. So under this method, tax is collected by applying the rate value addition, by applying the rate value on what? On the addition, which is this 8,000 naira. So, but if you want to look at it, it is similar to the tax credit or invoice method. But the tax credit and invoice method is the preferable method. Is what? Is the preferable method. So if you are asked, okay, in exam, that's which of the three methods of taxation is the most preferred, which one will you tell them?
Tax
Yeah,
credit or
answer.
invoice method.
And if you are asked that in Nigeria, which of the valid tax variants we practice in Nigeria, what would be your response?
Tax credit or invoice method.
Listen to my question again. They ask you in the exam that in Nigeria, which of the valid tax variants that we practice, which of the valid tax variants is practiced in Nigeria? What would be your answer? Hmm? Hello. What would be your answer?
I think it's the addition method.
Addition method with Igbo. Why addition method? For my country people. Variance, value tax variance. Mrs. Abosede, if you are asked out of the three variants, let me even assist you. Out of the three variants we have, which of the variants do we practice in Nigeria?
Consumption variance.
Huh? Consumption variance. Please, who is my student that joined with Techno Pop 4? Kindly name your device with the name. Okay, you guys did not register with us, but name your device with your name so that we can recognize you. Thank you, Techno, POP or POP4. Okay, so we practice consumption variance, in Nigeria. So that's good. So we can proceed. So what is tax credit or invoice method? So like I said, this is generally preferred over what? It is preferred to the subtraction method because offers facility in calculating export refund. It offers facility in calculating export refund, and that's why we do have input VAT. We have what? Input VAT. So the input VAT is what? Is a tax credit against what? Against our output VAT. So these are invoice method. Why do we call it invoice method? It is invoice method because we determine the input VAT you pay from your invoice. And that's why you see some companies, they tell you, get invoice from me. Okay, you must get your invoice, otherwise we will not pay you. Okay, so because that's the primary document. So from the invoice, if you have purchased goods or you enjoy services that worth 10M, okay, that was 10M. So, and you have paid VAT at what? At 7.5%. How much would that be? That should be around 750,000 naira, if I'm not mistaken. Abi? So that's your input VAT. And now you have used the raw material, you have converted it. Now it is readily available for sale. And thank God you have customer availability. All goods have been sold. Then the total amount you realize, let's assume there is no inventory. So all your goods were sold out for what? For let's say 20 million naira, 20 hen. So don't forget, you're also issuing invoices, or you must have issued invoice to your customers as well. So from your invoices, you have determined that all the goods that were sold what this amount. So from your invoice, we will see, do you charge value tax in your invoice? So if this amount is VAT inclusive, then we do what? We do markup. What do? We do markup. So we work back. Okay. So by saying 7.5 all over 107.5, work back. Okay. So, but if it is not VAT inclusive, what do we do? Just make this amount multiplied by 7.5%. So we are assuming that it is not VAT inclusive. Okay. So this is the net invoice amount. So the VAT on this amount we got will be 1.5. Will be 1.5. So our input VAT is what? Is 750,000. And our output VAT is what? Is 1.5. So this is a credit, it is a tax credit. Okay, it is a tax credit that can be enjoyed against what? Against the output. So what will you now be paying to the FIRS? You'll be paying what? 750,000 naira. Paying 750 what? 750,000. So this is what? This is due to the tax authority. And who is the tax authority? We have the FIRS. Okay, we have the FIRS. Are we together?
Hmm.
So is it clear?
Yes, sir.
So again, it allows for deduction of taxes paid on input form. Okay, it allows for deduction of taxes paid on input form and the taxes payable on output. So the tax payable is calculated by deducting the aggregate of taxes indicated on the invoice. So what's the aggregate of the tax indicated on the invoice? 750,000 naira. Abi? So the aggregate of the taxes indicated on the invoice received for purchase of inputs from the tax to be paid on sales, which is out. So when the VAT monitoring team of FRS come to your company for audit, so they will be asking you for invoice you receive on your purchases. If it's the manufacturing company, then the invoices you issued out, invoice received and invoice issued. And if for cash transaction, they may ask you for receipt, receive, and receipt issue. Are we together? Can someone tell me the difference between an invoice and receipt? What's the difference between these two documents? What's the difference between an invoice and a receipt?
Hello.
Hi.
Yeah, the invoice, the items of the goods being bought will be listed in the invoice, but the receipt will show the payment of the items being bought, purchased. I don't know if I'm right.
Mrs. Techno, is it Mrs. Techno? I've been Miss Techno.
No, Ajimat. I've changed the Techno to Ajimat.
It's still showing Techno from my end though. Okay,
Maybe it's the network.
okay. So, okay, you try. So, boss, I don't want to say something.
Yes, I'm trying to let you know that that is the second person joining us today. That's our new visitor.
Okay, that's your friend, Abby.
Yes, yes, yes.
Okay, okay, thank you. So good. You can speak.
Using layman's definition, I know that invoice can be
Hey,
raised.
sorry, you are a woman, you are not a man. So use laywoman definition.
Okay. Okay, I know that the invoice can be raised before payment is done,
Okay.
and then receipt is only given after payment is done. That's what I know about this too.
Okay, thank you. So that's just it. So invoice is usually used for credit purchases. That is, payment was not made at the spot of exchange, okay, at the time you are purchasing. So for instance, the vendor is delivering the goods to your premises. Okay, so as soon as the goods leaves the vendor's premises, you issue an invoice with, for instance, maybe a delivery note to the driver. So when the driver gets to your place, you submit the invoice with the delivery note, you match the goods you received with the goods that was on the invoice or delivery notes. If it agrees, you can make payment later. It depends on the your credit worthiness with the vendor. Some people after 5 days, some people immediately receive the goods and the likes. We used to do that too now for Jumia, isn't it? So maybe you have
Yes.
purchased time, pay on delivery. Abi, pay on delivery. They will not
Yes.
say because they have not paid, they will not issue invoice. They will issue invoice, isn't it? So,
Yes.
but you are paying the driver cash or you are using your ATM to pay the driver. So the driver will not issue you receipt because they believe that they have given you invoice. So, and if you want any evidence of payment, you can use what you can use. If you do transfer, you can use your transfer receipt. But if you are paying cash, there's no evidence of payment. But they believe that since the goods or the product is now in your custody, you must have paid. Because the instruction to the driver is if you are not paying, they should know what they should not deliver the product. So that's but for receipt, you have paid everything. So the driver will just get to you and deliver and come back. No other business with the driver. You understand? So receipts are usually issued for cash transaction. And in some organization, despite the fact that they have earlier issue you an invoice, when immediately you make payments, they raise a receipt. So they issue you a receipt to confirm, okay, to acknowledge your payments. Do you understand? Why in some organization, just as since they have sent you invoice, now that you have paid, the business is over. Do you understand? So that's why most people find it difficult to distinguish between an invoice and receipt. Please take note. So now that's that. Now we move to the next slide. Origin and destination principle. So forgotten her name now. Okay, yes, Mrs. Ajimat. Thank you.
Yeah.
So, what are the three methods? What are the three methods of value-added tax? Three methods of computation of value-added tax.
Additional method, subtraction method, and invoice method.
Tax credit or invoice method. So we have addition method, subtraction method, tax credit or invoice method. Thank you. So now we are moving to the origin and destination principle. I'm not referring to the origin that you know. I'm not referring to the origin. This origin is taxation origin. So taxation was taxation origin. But for destination, I'm referring to the destination that you know. Okay, I'm referring to the destination that in as much that we are both using dictionary and we are not using any other vocabulary, from somewhere else. So origin in this case is referred to as what? As source. Is referred to as what? Is referred to as source, not that origin. Okay. And destination here is referred to as what? Who want to assist me? Who want to assist me? Oh, hey,
Could it be the goal? Could it be the goal?
Could it be what?
GOL GOLAL.
Is that good? Good is a good. Okay. So anyway, so the destination here we are referring to, like I said earlier, is that destination that is. And what's the destination? We refer to it as home. Okay. We refer to it as what? We refer to it as home. So if I am referring to it as home, then you will be referring to it as what? As abroad, the place you are going to. You understand? So, or the place, let me just put it this way. Let me put it simply. Okay, where you intend or where you are what? You are going, where you intend going, or where you are going. So that's the question. Is it understood? Hello, you don't understand.
Yes. Yes.
Now, for instance,
Yes.
this woman living in Maryland. So this woman living in Maryland. Now, presently, at the moment, she's in the market. Okay. So at the moment, she's where? She's at the market. Okay, so she's at the market, to get some food stuff. So after some while, so she decides to go home. Okay. So now she's at the bus stop. She's now at the bus stop, looking for what? Looking for cab. She's now at the bus stop looking for cab. So a cab has arrived. Okay. So the cab has now arrived. So yeah, Baba cab, come and take me to my house. Boom, 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 from there. So where is our destination? Where is our destination? Someone should answer me now.
Home. Home.
That's our destination. But if she's here and she intends going to the market, where will be our destination? Where will be our destination? If she's at home and she intends going to the market will be our destination. Thank you. The market will be our destination. So I hope I was able to explain it simply. Okay. So now, value-added tax can be implemented under the origin or destination principle.
Principle.
Okay? So can be what can be implemented under the origin and destination principle. That is, looking at the source. Where is it coming from? So where is this person coming from now? She's coming from her house. Where is she going to? She's going to the market, isn't it? It's going to the market. And in other way around, if she's in the market, okay, what will be our source? The source will be the market. That is where she gets the tomatoes from, where she gets the pepper from, where she gets the maybe probably yam, any other food items. You understand? So when she's leaving the market, where will be our destination? Our destination will be our home. Our home. You can see that it can be used, you know, it's transformed in some cases. So now let me now bring it to business, imports and what? And export. Import and export. So we have import goods, we also have import services. We have exported goods and we have export services. So bringing the origin and destination to this business, we therefore mean that if you are importing goods, let's say from China to where? To Nigeria, from China to Nigeria. So if you like, use air cargo. If you like, use ship. Okay. So we all arrive to your destination as at the planned time. So then from China, they are bringing in all these China phone. Okay. So we are bringing China phone to Nigeria. They are now at the border. They are at the port. Okay. So you need to clear the what? You need to clear the products. So China, being the source country of the phone, being the what? Being the source country of the phone, will not charge value added tax. Will not do what? Will not do what?
Not
Charge
Charge
value
value
added
Not
tax.
charge value added tax, being the source country. Okay. If we are going by the source principle position, if we are going by the what? Source principle
Source
action,
principle.
I want to believe you understand what I mean by the source. I mean the origin. We are going by the origin principle taxation. So the China will not charge VAT on the what? On the phones. But immediately the phones enter Nigeria, okay, at the port, the custom, okay, we ensure that the customer that is bringing the goods to Nigeria pays what? Pays VAT, custom duty, and the likes before the goods can be cleared at the port. You understand? Otherwise, the goods will not leave that port. So they must pay. You understand? But in another case, China may charge value-added tax on what? On the phone. If phone is vatable goods in China, okay, and maybe to Nigeria, you don't care, don't need money. So we don't charge VAT, okay? So China will say because in Nigeria, which is supposed to be the destination country, okay, going by the destination principle, because they don't charge value-added tax, they don't even pay tax in Nigeria. So China may claim to charge VAT. Do you understand? So that what? So that this person coming to China to purchase goods will not evade tax. Will not do what? Will not evade tax. Hello.
Hello,
Do you
we're with
understand?
you.
Hi.
Okay. So now, under the origin principle, let us come back to the food. Under the origin principle, all goods, whether consumed internally or externally, are what? are subject to VAT.
Right.
Whether internally or externally are subject to what? Are subject to VAT. Now you are confused. This guy has just mentioned that on imports, the source country, which is the origin country, do not charge value-added tax. That is to the what? To the origin country, it is an export. Abi? To the origin country, it is what? It is an export. But to the destination country, what is it? It is an import.
Input.
Okay. To the origin country, it is what? It is an import. So in Nigeria, the system we practice is what is the destination principle. Do you understand? So my explanation earlier is focused on what? On the destination principle. And as for the origin principle, I made a reverse of my explanation by saying China may choose to charge VAT. You got that?
Mm-hmm.
Do you
Yes.
got that, Abby? So I said China may reverse by saying, no, I'm charging VAT because Nigeria is not charging VAT. Can you still remember I said that?
Mm-hmm.
Yes.
So that's the origin principle. So under the origin principle, all goods, whether consumed internally or externally, are subjected to VAT. So the implication of this is that VAT cannot be levied on value added abroad and consumed locally. Do you understand? The implication of this is that VAT cannot be levied on value added abroad and consumed locally. So in short, exports are taxable while imports are exempt. Again, I go back to that China and Nigeria. So because China has charged VAT, Nigeria will do what? We exempt the imports from VAT. Do you understand? Because China has charged VAT, Nigeria will exclude what? Exempt the
Okay.
imports from VAT. That's the origin principle. But the destination principle, China, you cannot charge VAT, okay? Because Nigeria will charge VAT. So China cannot say that, no, I must charge VAT. Because if the person, people will not even go there to go and buy. Because they know they will be paying what? Double tax, isn't it? They will pay VAT in China and they come to Nigeria, they pay VAT again. The implication of that is for other importers that are getting their products from another country other than China, in which the country, exclude exports from VAT, in which the country exclude what? Exclude exports from VAT. People will prefer to go to that country other than China. So that's the implication. So most countries practice what? Practice the destination principle. So this means that all goods home and abroad, okay, all goods home and abroad are what? Are taxable, but exports are what? Exports are exempted. So it means that the goods that you are exporting, we will not tax it locally here. Abi? We will not tax it what? We will not tax it locally here. But when it gets abroad, they subject to tax. Am I making any sense?
Yeah.
So then destination is normally used with the consumption type of VAT. So if in Nigeria we are practicing the consumption type of VAT, then our principle will be what? Will be the destination principle. I hope I was able to explain this. For further explanation, you can always refer to your study test, any other material. So now let's merge the origin and destination principle with two variants of value-added tax. Okay, with two variants of what? Of value-added tax. So the tax treatment of capital goods, under the four combinations of two variants and two tax principles is a matrix given by who? Given by Owell in 19 95. Okay, you have pay. So now this is consumption. This is production VAT. So what's this production VAT? I've forgotten. Under the VAT variance, this production VAT, what is it? Oh yeah, now I've given you expo. You have consumption VAT here, so you know that it cannot be income VAT. So it cannot be income variance. So what will it be?
Gross.
Gross product. Gross product variance. Thank you. So now we have the origin base and we have the destination base. Relating this to my example, okay, relating it to my example, for consumption VAT, the origin, tax, if exported, not taxed otherwise. That is, it is taxed in the home country. It is taxed in the home country. That is the country where the goods was produced. If when exported, it will not be taxed. Do you understand this? If when exported, it will not be taxed. That is, it will not be taxed in the destination country. That is the country that imports it. Are we together?
Yeah.
Then for production variance, for production VAT, so it is not taxed if imported taxed otherwise. That is, if it will be taxed in the destination country, the country that is importing the goods, then, sorry, if it is not taxed, okay, in the exported country, which is the home country, the origin country, then it will be taxed in the destination country, which is the country that is importing the goods. I hope it is clear. Hello.
Yes.
Then for the destination based, under the consumption VAT, okay, it is going where? It is going to a place. So in the home country, it will not be what? It will not be taxed. Okay, in the home country, it will not be what? It will not be taxed. But when you get to the destination country, it will be what? It will be taxed. Then for the production variance, okay, so this is not taxed. If what? If exported, taxed otherwise. That is at the point of import. Okay, so in the destination country, you subject it to what? You subject it to tax. If it will not be taxed in the what? In the country exporting it. Okay, if it will not be taxed in the country exporting it. So please take notes. So this one, if it will not be taxed in the country exporting it, then it will be taxed in the country importing it. So let's take an illustration before we end today's class. So please pay attention to details. So now that we know that value-added tax, we are using consumption tax variant, okay? So it is a consumption tax added to a product sales price, okay? It is a consumption tax added to what? Added to a product sales what? A product sales price, or you say selling price. So it represents what? It represents the tax on value what? Value added by its name, on value what? Value added. Okay. So the value you added to what? Value added to the product or services, product or services consumed. So now, if a manufacturer, so this is a quiz, so pay attention. If a manufacturer buys raw materials, in the sum of 300,000 naira, if a manufacturer buys materials in the sum of 300,000 naira, plus VAT, plus what? Plus VAT at 7.5% plus VAT at 7.5%. Okay, plus VAT at 7.5%. How much will the manufacturer remit to the tax authority? So is it the manufacturer that is buying the raw materials that will remit tax to the tax authority, or the vendor? Or the
The
vendor?
vendor.
That's fine.
Is the vendor.
Thank you. So now, the manufacturer that has purchased the raw material at 300,000 plus value-added tax at 7.5%, that's 22,500. I'm not mistaken. And someone assists with that. 7.5% of 300,000.
Yes, 22,500.
Okay. So now, on the invoice, what will be the total invoice amount? The invoice the
315.
manufacturer will be
322,500.
3,500 to 3,500. So this represents cost to who? It represents cost to who? It represents cost to manufacturer, right?
Yes, to the
Isn't it?
manufacturer.
But
Yeah.
do you know that you cannot claim the old 3,500? So what this means is that your cost of production, okay, holding other factor constant, okay, holding other factor constant, your cost of production will be what? Will be 300,000 naira. Why? Because this 22,500 is a what? Is a tax credit. Is a what? Is an input VAT.
That's good.
Yes,
Yes.
it is an input VAT. Are we together? It is what? It is an input VAT. So you set it aside. You don't add it to the cost of production. Are we together?
Okay.
So, except if what you acquire is a capital expenditure, maybe motor vehicle, do you understand, or any other related expenditure that is of capital item and it's subject to that. So that was my first squeeze. You get one part, miss that. So now, number two. Now, the manufacturer has purchased the goods. They agreed that the cost of goods should be 300,000 naira, and the value-added tax paid thereon should be an input part. Now, manufacturer has produced, it is now readily available for sale. So in this case now, there is no middleman. The manufacturer is selling directly to the retailer. So the manufacturer now sells at what? 500,000. The manufacturer sells at 500,000. Okay. So remember, he will also charge VAT, isn't it? So VAT at plus, so this 500,000 naira, so you charge VAT at what? 7.5%. So do the margin. 7.5% of 500,000.
37,500.
VAT, I've given you expo. VAT output will now be 37,500. So how much is the manufacturer paying to the tax authority? And which of the tax authority is the manufacturer paying to?
IRS.
FIRS.
Mm-hmm.
Okay. So if they are paying to FIRS, how much are they paying? This is
15,000.
yeah, you guys should be raising your hand if you want to speak. I want everybody to participate, and it seems just 2 or 3 persons hearing the voice. So I want everyone to participate because I'm giving you assignments and you submit. Last week is just one person that submits assignments.
I don't know.
So now, good. How much is this
Yes.
person paying to the tax authority?
Yeah.
You will pay 37,500
If
37,500. Why 37,500?
500 because
Why
that's
37,500?
the VAT of his goods for
537.
500,000 naira.
Ambrosia, how much should he
Because
spend on
that's
this?
The manufacturer, the
5% of 500,000 naira.
That's 37,500. So he pays 37,500 to the tax authority, right?
Yes.
it's 15,000, 37,500 minus 22,500, output VAT minus input VAT.
Correct.
Okay, so the manufacturer pays 15,000 naira. So remember, I said it earlier that to be your input VAT less your output VAT. You've forgotten. Input VAT, remember the illustration on this under the tax credit or invoice method. So going by the invoice, so the invoice he received the invoice of 22,500 VAT inclusive. So the VAT amount has been determined to be 22,500. Then when he's making sale, he charges 7.5% of the selling price or the sales amount, which is 500,000. So the VAT thereon is 37,500. So he's paying the difference between this 37,500 and the 22,500 to FIRS. Don't forget that the vendor that sells the raw material to the manufacturer has remitted this money to the FIRS. Do you understand? So 22,500
Okay.
is presently with the FIRS. The person has remitted it. So, and the manufacturer, because he's not allowed to claim the 22,500 as part of his cost of production, rather, he's expected to claim it as a tax credit. So, he is now, he will now claim that input VAT, which is 22,500. So it is the difference between the output VAT and the input VAT that is remitting to the FIRS. So to pay FIRS 15,000 naira. Do you understand? So now another
Yes.
question I want to ask is, what if the input VAT is more than the output VAT? In that case, you cannot charge more than the output VAT. Okay, you cannot charge more than the output VAT. So if your output VAT is 37,500 and you have input VAT of maybe 500,000 naira, or let's say 100,000 naira, you can only charge that 37,500. So any VAT input that is yet to be offset against that output will be carried forward. Do you understand? Will be what? Will be carried forward. So what this means in most instances is that probably you have not realized all the sales. Do you understand? You have not realized all your sales. So you can only enjoy to the extent of the sales you have realized, because it's not possible except you want to tell us that you're in business to make loss. Do you understand? So except you want to tell us that you're in business to make loss. So it means that you still have some inventory. Okay, then when we look at the inventory, it must give us, a VAT output higher and above the VAT. So that's that. So let's move to the retailer.
Sorry, are you
Okay.
trying to say that if, for instance, the input VAT is 500,000 and the output VAT is 37,500, maybe you remitted 37,500 to the FRS. The next month,
Sorry, can you take
you,
that again?
you
Sorry.
okay, you said that you can carry forward your tax, your value added tax. That's why I said, if for instance, in say January, your output VAT is 37,500 and your input VAT is 500,000 and you remitted 37,500 for January, are you saying that in February, if your output VAT is higher, are you going to now deduct the 37,500 that you paid earlier?
No.
No.
Yeah, you misunderstood my
Okay.
explanation.
Okay.
So what I said was that in this instance now, the output VAT is more than the input VAT. But in the case whereby the total input VAT you have is maybe 500,000 naira. So your VAT output there is 37,500. Okay, and your VAT
Okay.
is 500,000. So what's the difference? So you have 462,500. Am I correct?
Yes.
So this 462,500 is still a tax credit. So you are not paying FRS this 37,500.
Okay.
Because FRS is still owing you. So this is a tax credit.
Okay.
This is a tax credit. And I mentioned it earlier that the tax credit and invoice or invoice method is the most preferable method. And that's what we are using in Nigeria. You understand? Because it supports the consumption variance of tax or value-added tax. Is that understood?
Yes, sir.
Okay. So in February, if you realize, because what this means is that you still have some unrealized sales. You still have some inventory that have not been realized. You understand? So when you realize those inventory, then definitely you'll be able to utilize all these tax credits. But in a rare circumstance where the company reported gross loss, because it is only when you report gross loss that your outputs are VAT lower than VAT. And the FIS would like to checkmate. Okay, so they would like to investigate why you have reported gross loss. So probably it should happen in a rare instance. In a rare case, probably there is economic decline. Okay, so or maybe if there is inflation, you're not able to increase your selling price because of the competition, and like. So there must be cogent reason, verifiable reason. Okay, so for of why you got gross. The companies may have total loss. Okay, that's still it. So for that one, know that it's your administrative expenses or general expenses push you to loss. So it will push you to a loss position. You understand that? So now let's take the last situation. So if the retailer, okay, the manufacturer has sold the goods to the retailer. So if the retailer now sells to his final consumer, this is the retailer here now, selling to the final consumer at 1 million naira. There's profit in this business too, from 500 to 1 million. That's fine. Okay, so he's also charging VAT at 7.5%. Now, this is Ajimat buying these products. Okay, so she's paying VAT at 7.5%. So what's 7.5% of 1 million naira? So to Ajimat, this is a VAT output. This is a VAT output. So she's paying VAT of 75,000 naira. But unfortunately, because of the tax law, because it is an indirect tax, she will not be able to claim it. She's the one that bears the burden of the tax. Okay, remember the tax incidence principle and the tax incidence, part of the basic concept of taxation. Remember the tax burden, remember the tax impact. So the impact, the burden, the incidence is on Ajimat. Do you understand? So it's on Ajimat because she's the final consumer of this product. So look at, started from the vendor to the manufacturer to the retailer. So look at it through the supply chain. Through what? Through the supply chain. So this is the vendor to the manufacturer. Okay, from the manufacturer to the retailer. Okay, then from the retailer to the final consumer. Do you understand? So that's the supply chain. So now this vendor now is operating in the what? Let's say the extraction industry. If you did a business study, okay, then this manufacturer is in the conversion, okay, stage, conversion industry. Then the retailer is in the service what? That's the service person. Okay, but this is the person that I enjoy the product. So in that case, it is what this is the destination. Do you understand? This is the destination. Look at where the something is coming from the vendor to the manufacturer to the service provider, which is the retailer, then to the final consumer. That's the destination of the goods. Okay, so that's that. So now you have not answered my question. My question now is how much is the retailer paying to the FIRS? Sorry, can you see my screen?
Yes, we can see your screen.
How much is the retailer paying to the FIRS? How much is the retailer paying to the FIRS?
75,000 minus 37,500, which is
75,000.
37,500.
75,000 naira
Minus 37,500, which is
minus
37,500.
500. So how much is
37,500.
37,500? So to the retailer, VAT output 37,500.
Output is 75,000.
Sorry, 75,000 VAT input 37,500. So how much is it remitting to the parents?
37,500.
37,500 to pay FIRS 37,500. Are we? So now in aggregate, how much has the FIRS received so far? In aggregate, so this is the FIRS. In aggregate, how much has the FIRS received so far? So we have
75,000.
and we need to prove it. So we have the vendor. How much does the vendor pay to
22,500.
and the
Yes.
manufacturer pays how much?
37,500.
37. No. Are you whining? The manufacturer pays 15,000.
Sorry, 15,000.
I did not enter your one. So then the retailer paid how much?
37,500.
37,500. So in aggregate, how much is
75,000.
75,000? So that's what? That's the total amount received by the FIRS. So, and with this illustration, you should be able to give a good definition of value added. Value added tax is a multi-stage tax. Is a what? Is a multi-stage tax levied on consumption of goods and services that are goods and services that are subject to VAT. I repeat, value-added tax is a type of tax that is a multi-stage tax levied on, okay, let me take it this way. Value-added tax is an indirect tax. Okay, is an indirect tax. Full stop. Value-added tax is a multi-stage tax that is levied on what? On the consumption of goods and services that are subject to VAT in line with the Value-Added Tax Act. The examiner will just smile. Okay, just smile and give you your 1 mark. Really? Self-unique. Because it's a sheep definition, so you don't expect more marks to be applied to it. So, but I want to believe we all understand what value-added tax is right now. Hello, we all have a good understanding of tax.
Yes, sir.
We should compute the value-added tax. Yes or no?
Yes, sir.
Be able to compute
Yes.
the value-added tax accounts because it is simple. Then, if you can always remember that value-added tax is a multi-stage tax, then you know that your final answer, if you are asked to prepare the value-added tax account or the FIS account, you know, if you are to prepare the FIS account, you know they are referring to that value-added tax that is finally paid by the consumer, okay, by the final consumer, in this case, which is Ajima. Abi? So look at this, that as put to Ajima. Is that not what we arrive at? But the FIS cannot wait until Ajima consume the goods. Do you understand? They cannot wait until Ajima consume the goods. So immediately the vendor sells the product, yeah, our VAT. So if the vendor refuses to pay us our when due, it attracts penalty and interest. If care is not taken, it may lead to imprisonment. Yeah, from the vendor to the manufacturer. Yeah, the manufacturer, as you are selling, yeah, our VAT. We can't wait for the retailer to start making sale. So the manufacturer pays them 15,000 naira. Boom. They use it. Because government need money. And they can't wait the perpetuity, you know, for the consumer to consume the goods. There are some goods that will later be damaged. Okay. So then the retailer, oh yeah, as they are selling to Ajima, they are pay us. If Ajima likes, she should consume the goods instantly. If she likes, she should keep it somewhere and have collected their VAT. So, and if Ajima also decides to sell to someone else, only that the FIS may not know. Okay. So if she's selling to someone else, she may even sell at 1.5 million naira. But because she's not recognized as a business, okay, so she may evade that value-added tax. So that's one of the drawbacks, you know, of an indirect tax. So when the final consumer that we see as the final consumer is now selling, we may not be aware. And because the person is not in business, it may not be value-added tax. You understand? So a good example of this is all these second-hand cars that are buying. Okay, second-hand cars, second-hand jewelries, blah blah blah. Like so when you buy, you buy from a friend, no value-added tax, no withholding tax. Do your transaction, everybody move, which is fine for us. At least you not be paying value-added tax on everything. Right? No, be so, isn't it? So,
Well, I think the seller is the one benefiting.
eh, Okay, not the buyer.
Yes, in that case, when you buy from your friend. No,
You to where you buy, you to sell now.
because the seller is making profit.
And now is his own is her own lot now. She's not really making profits like that though, because she has paid VAT now. She paid 75,000. So if she's now selling the product and you deduct that 75,000, she has also incurred the cost. It is even you that buys from her that you are enjoying it. Because if you also decide to sell to someone else, have you incurred anything now?
Well,
So
she'll add some money to it to sell now.
no problem. Okay, so that's just it.
Okay.
So I wish you guys enjoyed today's class. So we have come
Yeah.
to the end of the class. So in summary, we discussed valid letters, the brief history of valid letters, discussed the definition, the variance of that, method, destination, source principle. That's we practice what we discuss. Okay, again, don't forget that valid tax is a multi-stage tax. Okay, so it is an indirect type of tax, and it is a multi-stage tax levied on goods and services, on consumption of goods and services, rather than on income or profits. So I have these takeaways. So from question 1, 2, 3, 4, 5, it's not up to 10. Anyway, you are lucky. So from question 1 to 5, I am, I have the confidence that if you take your time to practice this question, I don't want to know where the examiner, the angle the examiner may be coming from. On this topic, forget it. You are good to go. So thank you guys once again for joining me in today's class. We have successfully come to the end of this class. And I wish you guys, thank you too. I wish you, a success in your coming diets or in your coming exams. Do enjoy
Thank
the
you.
big days coming ahead.
Thank you.
Thank you, sir. Thank you, sir.